The standard economic model, the standard neoclassical economic paradigm, I think does us a huge disservice by not taking note of how within markets and civil society itself, we find ways of regulating economic and civil society activity in order to increase regulation. Well, thank you for inviting me again. I'm delighted to be here, and thank you for tolerating this session being in English. Unfortunately, I don't speak German. My daughter speaks fluent German, but she's not an economist, so I have to deliver this talk in English, I'm afraid. And just to say that the context of this talk is the very low level of productivity growth in Europe, which you've had for a generation really, and in the United Kingdom, which we've had maybe for 10 or 15 years, certainly since the financial crisis. And this is partly, in my view, because of the huge volume of regulation which stifles enterprise, which comes from both the European Union sources and also from domestic governments. And it's often thought that there's a need for governments to try to always step in and try to bring markets to some model of perfection which is described in classical economics or neoclassical economics textbooks. And there's actually little evidence to suggest that this is a successful policy. And not only that, there is a lot of evidence which suggests that markets can actually develop their own regulatory institutions, and that therefore governments don't need to, and it's indeed counterproductive for governments to try to regulate and bring to perfection markets. And I'll talk about some of the problems that gives rise to in a few moments. Now, people, of course, debate this question of the relationship between regulation and productivity. Some people argue that certain forms of regulation within markets actually increases productivity. But I certainly would argue that if markets can be regulated by institutions which arise within markets themselves, or within civil society for that matter, that you'll get a much more effective and more moderate form of regulation which will allow markets and enterprise to flourish. There are some of you I know from talking to you last night and this morning who are interested in Catholic social teaching. I might just relate this talk to that body of work, although this is the only comment I'll make in that respect. There was Pope Benedict XVI wrote an encyclical letter in 2009 called Caritas in Veritate, in which he lamented what he described as the binary market plus state division. In other words, you have all this commercial activity happening in markets, and then you have the state which is regulating markets. And this was partly expressing concern about the fact that institutions that had arisen in past times from within civil society to regulate economic activity had been eroded. So my talk in some senses relates to that concern. Now, I'll go back into the history of this in a few moments, but I want to start by saying that I think the problem starts, and in particular the idea that somehow only governments can regulate markets arises because of the way economics is taught, especially in universities. And it's taught in a very sterile way. Economics texts have both a very unrealistic view of how markets operate, and from that they derive then a very unrealistic view about how their operation can be improved by government. So the typical approach which is followed in economics textbooks, for example in this book which is used very widely in the UK by Sloman Garrett and authored by Sloman Garrett and Guest, starts by proposing a very unrealistic set of assumptions which are necessary for markets to maximize welfare. And these assumptions include perfect knowledge on behalf of all market participants, no social costs or benefits, so-called externalities, of our economic activity, and, say, a large number of buyers and sellers to create a competitive market. And it's argued, and this phrase is actually used, and it's explored in detail in this book in several chapters, it's argued that if these assumptions don't hold, plus a few others, there is said to be so-called market failure. And because the conditions don't exist, it's argued for the maximization of economic welfare. And then it's proposed, again, in several chapters in books like this, that there's a case for government intervention to regulate markets so that, in various ways, so that they behave as if they would have behaved had these assumptions, perfect knowledge, no social costs, large number of buyers and sellers and so on, held in the first place. So, in other words, the economic textbook sets up a totally unrealistic narrative as to the assumptions that are necessary for markets to maximize welfare. They then argue that if these assumptions don't hold, we need a government bureau somehow to regulate the market to make it act as if they did hold. And this approach in the typical economics textbook is, of course, followed with great alacrity by financial regulators. They latch on to this idea that markets have to, that these assumptions have to hold in order for markets to maximize welfare, and they note that these assumptions don't hold, and therefore the job of regulatory bureaucracies is necessary to improve market outcomes. So this is a quotation. It's from a while ago, but it's from our one of our financial regulators in the UK called the Financial Services Authority, and it talks about how in meeting our objectives in a manner consistent with the principles of good regulation, we have adopted a regulatory approach based on correcting market failure. In other words, it's absorbed this idea that these assumptions, unrealistic assumptions, have to hold for a market to be performing its functions properly. It then says there are numerous cases where unregulated markets will not achieve the best outcome due to some form of market failure. Well, in fact, these assumptions that economists posit, they never hold. So, in fact, no, in every realistic market scenario, the markets will exhibit what these economists call market failure, making action on our part necessary. So this is the a financial regulator in the UK, which is effectively accountable to nobody at all except itself, saying that it has unlimited discretion, really, to intervene in and regulate markets in order to try and improve their outcome. And I'll mention one or two of the results of that in a couple of moments. Now, this whole approach to economics, which lies at the heart of neoclassical economics textbooks, the sort of thing that you will study in every university in the UK, I should imagine every university in Germany and every university in the US, it's just a totally unsatisfactory way of thinking about how markets work and what the role of governments should be in trying to improve markets. So, as I've suggested, no market can possibly satisfy the assumptions for welfare maximization. There are no situations in which all buyers and sellers of a good or service have perfect information, where there are large numbers of buyers and sellers, where there are no external or social costs or benefits from our activities within markets. So no market at all will ever satisfy the conditions which neoclassical economists seem to demand. However, if these conditions don't, I think Milton Friedman's son, I've forgotten his name now, but anyway, Milton Friedman's son has drawn this analogy that the theoretical top speed of a car is the speed of light. Okay. If you have no friction and so on and so forth, a car could travel at the speed of light. But we don't regard a car as having failed if it doesn't reach the speed of light. In fact, in some senses, it would be catastrophic if it did. But we don't regard a car as having failed if it doesn't reach the speed of light, or if it doesn't consume energy in some way. So it is pejorative and indeed ridiculous to use this sort of language of market failure if these conditions don't hold, that we know simply never can hold. So that's the first problem with this kind of market failure approach. We set up a kind of unrealistic model of a market which can never hold, and then we describe the market as having failed if the conditions which underlie this model don't exist. But the other problem is that, or the second problem is, if the conditions don't exist for welfare maximization within markets, if we don't have these conditions of perfect information, many buyers and sellers, no externalities, and so on, we don't actually have the information to know how the market, know what the results of market activity would have been had those conditions existed in the first place. So if we don't have perfect information, then the market, according to this approach, will not maximize welfare. But we don't know what the outcome of the market would have been had we had perfect information. This was Hayek's observation, that if the conditions do not exist for welfare maximization in markets, we simply can't make the market behave as if they did exist, because we don't know what the outcome would have been had they existed. Then thirdly, if your answer to so-called market failure is to set up government regulatory bodies which are designed to try to move the market nearer towards a welfare maximizing outcome, this is really presupposing that these regulatory bodies themselves don't have their own aims and objectives which they will fulfill instead. We assume that people within markets act in their own self-interest, by and large, in most economic activity. But what about regulatory bureaucracies? Do they really act in a disinterested way to try to improve the workings of markets, or do they follow their own aims, try to increase their regulatory power, try to increase their size? Do they get captured by the companies that they're trying to regulate and develop regulation which keeps competitors out of markets? We know that real-life regulators don't behave according to the assumptions that economists make, that they somehow act in a disinterested way to improve the workings of markets, just as we know that real-life markets don't act in the way that some economists assume. So we have two fatal problems, really, when it comes to the standard economist approach to regulation. The first is that the market is being held to an unrealistic standard in the first place, and the second is that a government agency, a government regulator, cannot, either in theory or in practice, be assumed to successfully move the market to a better position by using its regulatory powers. It might do so, but it's difficult to know in advance the conditions in which it will do so. Okay, so that's the theory bit. Sorry if that's been a bit complicated for immediately after lunch, but it gets more relaxing from this point onwards. In reality, we see several problems when governments try to regulate market economies. And we certainly see situations in which, even if the regulatory bureaucracies are not pursuing their own aims, they certainly give a very good impression of doing so. Or perhaps they just have a culture which leads them to become very risk averse and just write more and more regulation rather than actually try to improve the workings of markets. So it's now become very difficult to track these things, but in 2011, one of the financial regulators in the UK produced a number of words in guidance, advice, discussion, consultation, or regulation, which totaled 4 times the number of words in the Bible, so in 1 year alone. So if you're operating in financial markets and you're regulated by the Financial Services Authority, or the Financial Conduct Authority as it was, I think, by then, just trying to understand and stick to this regulation is incredibly difficult. And of course, it makes it much more difficult as well for small businesses to enter the market, so markets then become less competitive. There are economies of scale, in a sense, in dealing with regulation. So it becomes very difficult to enter markets which are very heavily regulated. The financial regulator in the UK has the ability, the authority, to determine its own burden of proof, levy fines, prevent people from working in any area of finance, and has wide-ranging enforcement powers, really equivalent to those which normally exist within civil and criminal courts, but with none of the accountability or guarantees of due process. So the financial regulators in the UK regularly impose fines on participants in financial markets of over £1 billion a year, without the kind of accountability that normal court processes have. Now, Andy Haldane, who used to be chief economist at the Bank of England, and is no particular friend of deregulated markets, in a speech in 2012 to an important monetary policy conference that takes place in the US every year, noted that back in 1980, there was one regulator in the UK for every 11,000 people employed in finance. By 2011, there was one regulator for every 300 people employed in finance. If you project that forward to 2070, by 2070 you'll actually have more regulators than you will have people working in finance, and that excludes all of the people, all of the lawyers working in compliance departments of financial institutions as well. So when people try to argue that somehow under Reagan, Thatcher, and so-called neoliberal attitudes in the European Union, that markets have become much more deregulated, it just isn't true. No, since the 1980s, markets in many senses have become much more highly regulated. It's certainly true that more things are permitted. In 1979 in the UK, we had exchange controls and wages and price controls and so on. But everyday economic life in European Union countries, in the UK and in the United States is much more heavily regulated. And there's no evidence of any of this leading to a reduction in financial scandals either. So again, in the UK, there was very, very little regulation of the banking industry until we joined the European Union. And then we had deposit insurance imposed upon us, and then there were the Basel agreements, which regulated the capital that banks had to hold. And there's been no banking scandal, no serious banking scandal, no serious banking failure in the UK between 1870 and 1980, over 110 years. And then regulation gradually increased, and as regulation increased, it actually distorted the decisions that banks took. And much of the regulation, which was imposed on banks from 1980 onwards, and especially from 2000 onwards, made the financial crisis much more likely and its effects worse than it would otherwise have been. So, whilst it would be wrong to say that it's clear that government regulation of financial markets makes crises more likely, there is certainly no clear evidence that it makes crises less likely or their effects more benign. Now, fortunately, there's a way through this twin set of problems. We have markets which don't maximize welfare in the way that some argue that they should because of problems such as information asymmetries, externalities, etc. And then we have government regulators which don't, in the way that some people hope, improve market outcomes. So you might ask the question of why, if the regulation of markets can actually improve economic welfare, why do markets not spontaneously develop their own regulatory institutions? If a company thinks of an innovation in terms of its product design, which people will value, it will produce that product and market it in order to make more profits, and it will increase economic welfare in the process. So if there are particular problems in markets which can, in theory, be solved by the regulation of the market, why doesn't the market itself develop institutions which can regulate economic activity to try to resolve those problems? And the answer is that it does. And it does that in many spheres which you might well have thought of, or in some cases might not have thought of. So I'm going to go through three of those spheres, sort of civil society and land use planning, very briefly, then sport, and then financial markets, which is my main focus and has been my main academic interest. So, this is Friedrich Hayek's favourite club. He was a member of the Reform Club in Pall Mall in London. And clubs, this may seem like a trivial example, but clubs and hotels have rules regarding behaviour in different parts of their premises in relation to things like dress code, whether mobile phones can be used. They realise that one person's behaviour has an impact on other people. So they develop rules in order to try to regulate people's behaviour for the benefit of everybody. Hotels do that, private clubs do that. They also, of course, have rules, clubs, but not hotels. Clubs have rules about who can and cannot join as well, in order to try to ensure the probity of their members. This is Cambridge University, I think. It's either Cambridge or Oxford. And universities have rules about the behaviour of students as well. And those rules exist because by imposing those rules about student behaviour, it improves the welfare of students on aggregate. Indeed, there's competition between universities. Universities have different rules, especially in the United States. Some universities have really strict rules about the behaviour of students, and other universities have almost no rules at all. So this kind of private rulemaking, if you like, in the university system, it's existed for several hundred years. A better example, these may seem trivial, but I don't think they're unimportant. But they affect a relatively small number of people at any one time. A more interesting example is the way in which private organisations develop within markets to regulate housing developments. So we assume that certainly in the United Kingdom, although this is much worse in the United Kingdom than it is in Germany or Austria, but in the United Kingdom, we assume that the government, either at local or national level, has to regulate every aspect of a proposal to build new houses or to build new offices. So if I want to build some new offices in the middle of Twickenham, say, where my university is, I have to put a proposal to the local planning authority in the local government, and they will regulate every aspect of that design. And that process will take months, if not years. There was a planning consultation in the UK about building a tunnel under the River Thames. And the cost of actually getting the proposal from the design stage through the planning authorities who were determining the design from the point of view of a planning perspective was £297 million. The cost of that process, the regulatory process alone, was 1.5 times the cost of building a tunnel in Norway a few years ago that was even longer. So in the UK, to a lesser extent, in continental Europe, the design and planning of buildings, whether houses or offices, factories, etc., is entirely a task taken on by the state. But we have many examples from the past of privately planned villages, towns. Letchworth Garden City is an example. The example here I've used is the Bourneville estate, which is a large estate near Birmingham, built in the 19th century. When the Bourneville estate was built, it was recognised that the behaviour of one resident has impacts on on other residents. In other words, that there are externalities from the behaviour of residents, and that somehow the welfare of all the residents combined can be improved if that behaviour is regulated. So a trust was set up, and that trust is a private body of which all the villagers are members, and they determine the rules by which everybody who has a house on the estate needs to live. So, for example, you're not allowed to keep caravans, trailers or boats on your driveway. If you change significantly your home's external appearance, it has to be approved by the village trust. You're not allowed to have hedges, walls or fences around the garden, and you can't rent your home out without permission from the trust. Any of these rules can be changed at any time, but it's the trust which does this. It's not a local authority or government body. Now, to take another example, again, which you might not have thought of, where private regulation actually still today, rather unusually, because government has crowded out private regulation in most of these fields, especially in finance, but one place where private regulation is still dominant is in sport. So sport is entirely, football at least, is entirely regulated by private bodies. So in England, we've had the Football Association since 1863, and it was established not just to determine the rules about how two teams would play, you know, when is a handball, and so on, but it's established all the rules by which teams must operate, the rules of the competition, and if you don't like the rules, well, you can go off and set up another football league of your own if you wish to do so. So there are rules about transfers, limits on salaries, and also, crucially, the spreading of income from the top clubs down to a much wider base of clubs. And the clubs abide by these rules because they know that there is a benefit to the game as a whole if there is a flourishing football industry, not just in the elite clubs, but also at a much lower level. So in England, there are 40,000 football clubs registered with the FA, with over 800,000 players. All of these clubs and players abide by FA rules, and the smaller clubs are subsidised by the larger clubs because the larger clubs know that there is an externality here, that they benefit from, that the whole industry benefits from the larger clubs subsidising the smaller clubs. And then this goes on not just at a country level, but at a European-wide level through UEFA, and then through on a worldwide basis through FIFA. So the whole of world football is actually regulated by private regulatory bodies, national football associations, UEFA and other continental football associations, and the FIFA, which regulates the world game. There is no state involvement at all in that process. And in fact, interestingly, the UK government, and not just the current Labour government, but its predecessor Conservative government, is in the process of establishing a government regulator for football. So just as the government has taken over the regulation of the planning of housing estates and the regulation of financial market activity, it's now decided that it should take over the regulation of football because it can somehow improve the market in football, take it closer to this sort of holy grail of the perfect market. And last Sunday, Saturday or Sunday, the General Secretary of UEFA actually wrote to the Secretary of State for Culture in the UK saying, we have concerns remaining about your proposals, as football regulation should be managed by the National Federation. One particular area of concern stems from one of UEFA's fundamental requirements, which is that there should be no government interference in the running of football. So this is one remaining area, sport, where the private regulation not only is still predominant, but it strongly resists still regulation from the state. Whether that will change the mind of our government, I don't think it will, unfortunately, but we'll wait and see. Now, it's reasonable to say, and I'll move on to some other examples in a second, that if you go back to 19th century Britain, and indeed much of continental Europe, and also continental Europe in medieval times, people who participated in markets would actually have regarded it as part of their civic responsibility to develop institutions to help regulate activity within those markets. And one particular example of where this happened was in the field of securities markets. So the first stock exchange of note was in Amsterdam. This was an entirely privately regulated securities market. Many of the contracts traded on the Amsterdam Stock Exchange were not actually legally enforceable, but the level of trust between people who operated within the exchange was such that it was effective in regulating the exchange of securities. Not long after that, the idea of securities exchanges, which were entirely privately regulated institutions, developed within the United Kingdom. And I think it's probably in the UK where you've actually had the best example over a sustained period of these institutions operating. So as soon as people desired to exchange financial securities, whether they be company shares or government bonds or whatever, they need both a place to trade, but they also need the confidence of a regulatory framework to promote order. People naturally, in order to maximize the market for securities, make the market as liquid as possible to allow people the maximum opportunity to buy and sell, will be in situations where they're buying and selling securities amongst people they don't know. And it must be possible in these situations to develop regulations which promote trust amongst participants. So these institutions, they actually started in coffee shops. And so in Britain, the first stock exchange emerged in coffee shops such as Jonathan's Coffee House, the one pictured there. And then a group of 150 stockbrokers and jobbers formed a club in 1761, which followed more informal arrangements. And then that club in 1801 to 1802 moved to Capel Court, round the corner, and it remained there for 170 years as a thriving stock exchange. And the characteristics of that exchange included restrictions on membership, rules about the probity of members, the publication of prices to try and get over the problems of information asymmetry. And then from 1812, there was a development of a formal rule book. So when you have something like a securities exchange or any financial exchange, there are effectively externalities from good behavior and bad behavior. If people don't know each other all that well, which is normally the nature of trading markets, and some people start to behave badly, then it reduces confidence in the market as a whole, and people will be less willing to trade, and then there'll be a loss of economic welfare. So, according to the economist model, you have these externalities. You also have information asymmetries. It's very difficult for people to tell between trustworthy people and non-trustworthy people. And so according to the neoclassical economics textbook, you need a government regulator to fix these problems. But of course, these are problems which people benefit from fixing themselves. So these exchanges developed with rule books, with requirements for membership, restrictions on membership, the proper publication of transparent prices, and this type of thing, because the existence of those rule books benefited all parties involved. Now, I mentioned that in 1812, the first formal rule book was developed. Before 1812, there was for some time the idea of trading on account, which allowed people effectively to gamble on securities. So I could sell to you shares in a particular company or government bonds, but I wouldn't actually have to pay for those, you wouldn't have to pay for those shares now. You would pay at the end of the account period, which might be in 2 weeks' time. And you might decide to buy shares without having the money to pay for them at the end of 2 weeks, in the hope that the share value had gone up. You would then sell them for a higher price and then pay me and keep the difference. And that's what people did as soon as trading on account was done. People speculated. And of course, some people, at the end of the account period, were unable to pay their debts. So in a sort of early, informal way of ensuring that people knew who was trustworthy and who was not, a board was put up in Jonathan's coffee shop, and the people who didn't actually deliver on their bargains at the end of the account period were listed under the heading lame duck, which is where that phrase comes from. But then codified rule books were developed. So we had codified rule books covering settlement, defaults, arbitration and bad debts from 1812. And then from the mid-19th century, we had rule books regarding the quotation of company shares. So if a company wanted to have its shares quoted on the stock exchange, it had to fulfill certain conditions and be admitted to the exchange by the exchange committee. And it benefited everybody that there was a strict but reasonable set of rules around the trading of securities, because it lowered the cost of capital for the company. Now, several times in the few hundred years from Jonathan's coffee shop starting until 1986, there were governments considered actually stepping in and regulating these markets formally. And there were a couple of royal commissions about this issue, but one of them concluded in 1878 that the stock exchange's rules were capable of affording relief and exercising restraint far more prompt and often satisfactory than any within the read of the courts of law. In other words, these private regulatory institutions worked. Not only did they work, but they worked better than the government's own law courts. Indeed, the stock markets became not just efficient, but the people who operated upon them became so trustworthy that in 1923 the stock exchange adopted as its motto the phrase, "My word is my bond." So when I worked at the Bank of England, lots of people talked about how if you had regulation in different countries, you'd get competition between those companies and you'd get a race to the bottom in regulation. And the European Union also used that argument as an excuse for harmonizing regulation. This just doesn't happen, and there's no real evidence of that. Competition between different regulators won't necessarily lead to stricter or less strict regulation. It ought to lead simply to better regulation, because people want well-regulated, people want to operate in well-regulated markets. And that really is our experience of the private regulation of financial markets. Now, there are lots more examples of this. I won't go into detail because time's getting short. But just as we had the stock exchange for the exchange of financial securities, operating over several hundred years from 1691, we had the Baltic exchange, which developed in order to facilitate the broking of and chartering of ships. And just as the stock exchange did, it developed codes of practice. If members don't follow those codes of practice, they get kicked out. Its motto also became, actually, my word is my bond, and that's still a thriving and successful market today. Another example of private regulation which still actually works and its function hasn't yet been taken over by the state, although governments did threaten to take this function over after the financial crisis, is the International Swaps and Derivatives Association. So there are literally trillions of dollars of over-the-counter derivatives outstanding at any one time. A huge proportion of those are written under ISDA standard contracts, and when there is a potential default or a potential payment needed in relation to one of the derivatives written under that standard contract, there is a committee of ISDA which determines whether or not payment should be made, a set of regulations and so on which regulate this market. And ISDA's mission is to foster safe and efficient derivatives markets to facilitate effective risk management for all users of its products by developing standardized documentation to promote legal certainty and maximize risk reduction. And during the financial crisis, credit derivative swaps were strongly implicated in lots of the problems which arose within banks, but at no time was there a problem with the operation of ISDA and the operation of credit derivatives which were written under ISDA's contracts and subject to its credit determinations committee. Another example, finally, or more or less finally, is that of professions. Now, these days, I'm an actuary as it happens by profession, professions are incredibly heavily regulated by government. If you go back to as recently as 1990, accounting professions like mine, were more or less independent private bodies, which issued their own standards, and professions were trusted to adhere to those standards in the conduct of their business. Just as when the state took over the regulation of banks and securities markets business and so on, which it did in the US in the 1930s, in the UK in the mid-1980s, the state has taken over the regulation of professions. And so, and when it does so, well, it does what regulatory bureaus know best, which is to write regulations. So if you go back to 1970, there are about 16 pages of accounting standards which professional accountants had to adhere to. And they were advisory, and accountants were expected to use their judgment. Now in the US, there are 25,000 pages of statutory accounting standards which have to be applied by all accountants. And of course, these are entirely incomprehensible to anybody who is actually using those standards, unless you are a qualified accountant, probably working in a large company where you have excessive specialization of functions, so that people only know their little bit of the business. The European Union uses an equivalent, the International Accounting Standards, which are a mere 6,000 pages long. But there's no particular evidence that you need state-regulated accounting professions. In 1926, 90% of US companies actually had audited accounts audited by a professional, with no statutory requirement to have an audit at all. And of course, the reason they do that is to overcome information asymmetries. This assumption necessary for a perfect market of no information asymmetries. We know it doesn't hold in most cases, but the markets solve that problem if left to themselves. They developed professional bodies of accountants who owed a duty to the profession to act with probity, And companies knew that if they hired a professional accountant to sign off their accounts, that it would reduce the cost of capital, because that would be an indicator that the company was behaving in a sound way. Now, of course, there are always scandals. There always will be scandals. But once again, there's no evidence that the government regulation of the accounting profession has led to fewer scandals. Now, a few final examples of stuff that's perhaps current. These are not regulatory bodies in the same way that exchanges are regulatory bodies, but they are ways in which markets themselves find solutions to these problems which neoclassical economists call market failure, and that governments often use as an excuse to set up regulatory bureaus to regulate markets. So TripAdvisor, for example, overcomes information asymmetries in the markets for hotels, restaurants, etc. It's now using AI tools, actually, to provide really good summaries of the reviews on TripAdvisor. And this also promotes competition in other ways, actually, because when I was your age, if you wanted to stay in a hotel and you wanted to know that the hotel was going to be reliable, you really had to stay in one of the big chains which had a good reputation. Now it's very easy for even a small hotel to get a good reputation just by behaving well, treating its customers well. It then gets a good review on TripAdvisor, and lots of other people will want to stay there too. Airbnb, of course, works in a similar way. I don't know so much about them, but crypto exchanges, I don't think regulate activity in the same way that stock exchanges used to regulate the activities of their members, but nevertheless, they are a sort of intermediary body which is doing something in this space. Some of you will know more about crypto exchanges than I do. But Uber is a sort of cross between TripAdvisor and a securities exchange. So if you, I don't use Uber, but if you do use Uber, it rates the passengers for the drivers and rates the drivers for the passengers. Therefore, if you book a taxi late at night, you want to get home from a party or whatever, how do you know whether that taxi driver is going to fleece you, treat you very badly, possibly beat you up, take you to a rough part of town or whatever, or take you on a very long journey when actually the journey is very short? Governments have regulated taxi businesses down the ages to try and avoid those types of problems, and in doing so you've ended up with lots of cities where taxis are incredibly expensive, and you can only enter the taxi market by buying a taxi license from somewhere. Well, Uber has resolved all of those problems by ensuring that it transparently rates all drivers and all passengers, therefore breaking down these information asymmetries and promoting competition at the same time. So, to sum up, it's an historically verifiable fact that regulation doesn't have to be provided by government in the way that almost all the standard economic textbooks suggest. Now, whether or not regulation is better not provided by government or is better provided by governments is an empirical issue. But it's undeniable that markets do develop their own regulatory institutions across a very wide range of situations. I would argue that better incentives exist within private regulatory systems. Private participants in markets, they want well-regulated markets, but they don't want markets where regulation is at such a high level and becomes very bureaucratic and so on. Those same incentives don't exist within government regulatory bureaus. And within a government regulatory bureau, those who work in them may well pursue their own maximising goals of simply writing more regulation, making the bureau bigger and more important. Or the regulatory bureau may become captured by those companies that it's trying to regulate, and regulations might be developed to keep out competitors. And even today, across quite wide areas of social and economic activity, markets and civil society develop bodies to regulate activity. I think perhaps the best example today is in sport, and particularly in football, but there are many, many more examples before the state effectively took over the function of these bodies. And it is, in fact, if you put away your neoclassical economic textbooks and get out your Austrian economic textbooks, I think you can say that it is actually an act of entrepreneurial discovery to develop a regulatory institution within a market itself. And if it succeeds in increasing welfare, it will survive. If it doesn't succeed in increasing welfare, it will just wither and fail. So people operating within markets have incentives to develop mechanisms to overcome these problems which neoclassical economists talk about within markets. And I think, one concluding sentence, I think that the standard economic model, the standard neoclassical economic paradigm, I think does us a huge disservice by not taking note of how within markets and civil society itself, we find ways of regulating economic and civil society activity in order to increase regulation. If you read a neoclassical economics textbook, it's as if these entities just simply don't exist at all, which when it's very clear that they have done in history, they've been very important in history, and in some limited fields, they're still very important today. So thanks, happy to take questions.